Hi, everybody. So it's 7:03. Thank you all for joining us for tonight's webinar. Today's one is actually regarding China. So it's 2023 growth outlook with Kraneshares, right? So for today's speaker, right, we have Ritesh. So he's the head of investment advisory here at Syfe Singapore and also responsible officer over at Syfe Hong Kong Limited. So Ritesh leads the advisory team. Is a key member of the investment team as well. Formerly a private wealth advisor at Goldman Sachs, working with ultra high net worths and family offices and corporates. But before Syfe, right, he was actually at Morgan Stanley, where he quickly rose to become vice president at market risk. He holds an MBA from the prestigious Chicago School of Business. And joining us from Kraneshares, we have Brendan. So Brendan is Chief Investment Officer over at Kraneshares. He's actually located over in New York right now, I believe. So thank you for joining us for today. He actually leads the firm's research and education efforts and actively works with investors on a variety of subjects from asset allocation to trading and also growing influence that index providers hold, right, in the asset management industry. And before Kraneshares, he was over at Barclays Global Investors, which quickly became BlackRock iShares, which he actually joined back in 2001 during the rollout of the ETF business. Right, his career has spent a period of tremendous growth for ETFs. So this contributed to his profound knowledge of the ETF landscape.
Hey, Melvin, thanks for the quick introductions to me and Brendan. Brendan, I'm really excited to do this webinar with you. Given what has been happening in the Chinese markets over the last few weeks, I think it is an opportune time for us to do this webinar and also kind of like, look forward to your views in terms of market outlook for China going forward. Just before that, I'd like to quickly introduce Syfe. A lot of the folks that have joined in today are existing Syfe clients, but there must be some who have joined in for the first time. So Syfe is a digital investment platform. We are headquartered in Singapore, and we are on a mission to democratize investments to everyone. In terms of what we are building the next generation of financial solutions, and very importantly, making it accessible and affordable to clients across Singapore and beyond. If you move on to the next slide, what we have done so far is built you an all-in-one platform. So we have our wealth platform. We also have a trading platform. Through the wealth platform, our clients are able to invest into managed solutions. They are able to custom build their own portfolios. And through the trading platform, they're able to express their views into individual securities, ETFs around the world as well. To this extent, we have also won a few key awards recently, including the Wealth Management FinTech of the Year award. You move on to the next slide. If you look at our journey so far, it's really been a journey of innovation. We started off in 2019, and we have a wide range of investors on our platform, with our oldest investor being close to 94-year-old, showing that basically it's never too old to kind of start your investment journey. As I said, we pride ourselves for innovation, and we have developed very unique firsts in this market. And to name a couple, right, we have our REIT Plus portfolio, where we partnered up with SGX to launch the first direct indexed REIT portfolio in Singapore, tracking the iEdge S-REIT Leaders Index, as well as Asia's first custom ETF builder, right? So some of these things have been super innovative, things that previously people didn't have access to. And, that has really catapulted us to being a dominant digital investment platform in Singapore. And now we have, this year focused a lot more on expanding our business beyond Singapore, right? We launched our trading platform earlier this year, but over the period of this year, we expanded just in a matter of 6 months from one location, which is Singapore, to Hong Kong and Australia. We also announced earlier this year that we have more than 100,000 users in Singapore, which is, again, a proud milestone for us, touching more than 4 to 5% of the adult population in Singapore. And finally, today, right, let's move on to the next slide to kind of go over the agenda. Obviously, China is something that is top of mind for everyone. We will go over, some key aspects related to China as a country, as a market for investments as well. I'll hand it over to Brendan subsequently so that we can hear firsthand from his expertise what the views are from Kraneshares, as well as like more broadly looking into and peeking into 2023. We will then go into a fireside chat. I have a few prepared questions, so we'll go over those. We will then, quickly introduce Syfe's platform, ways for you to access China through our platform, as well as, then wrap it up through a Q&A session. Before we start, let's do a few quick polls. So the first one is, how much of your investments do you allocate to China? 10 to 20, 0 to 10%, 10 to 20, 20 to 40, more than 40%. And the second is, what is your top concern when investing in the China market? Obviously, COVID-19 regulations, regulatory risk, aggressive foreign policies, and housing market related issues. And number three, are you looking to increase your allocation to China in the new year, right? Yes, no, still deciding. All right, so looks like 0 to 10%, pretty dominant, but also, there are people spread across different buckets as well. So depending on your conviction in China, there are, folks who are invested all the way more than 40% as well. And that is something that you don't see. I think like, Brendan, I'm sure if you ask the same questions in a market like US, the answers will be much, much lower, mostly in the 0 to 10% range. Versus in this part of the world, as you can see, there is interest in China, which is much more than what you'll observe probably in the Western hemisphere. Top concerns, regulatory risk, foreign policies. I think some of these you will address during your coverage, as well as looking to increase allocation to China into the new year. So a lot of people are still deciding. So again, your inputs will be valuable. And looks like, between yes and no, there is more yeses. So, looks like the positivity in China is increasing as we move forward. All right, let me just quickly cover a few key things on China in terms of top of mind. So obviously, the dynamic zero COVID policy, we have seen the geopolitical and regulatory risks having its toll on the Chinese capital markets over the last couple of years. The fiscal and monetary policy is also kind of evolving in a different direction compared to what we are seeing in the US market. And then there is this whole thing about the 2023 reopening and the general kind of growth outlook for China as we move forward. If you look at the state of the market in the next slide, 2022 has been tough. And it's kind of a continuation of the second half of 2021. You can see that there has been, it's been a much more volatile journey for the Chinese market. So the blue and the light blue lines has been much more volatile compared to, say, S&P 500 and MSCI World. It went to a point where the Chinese internet sector was down more than 50% this year. Obviously, the last 1 month, there has been a recovery, but still, overall year-to-date basis, the Chinese market is lagging behind, their global counterparts. But if you look at what's been happening over the last 1 month with all the news of reopening, the Chinese market. So if you go on to the next slide, Melvin, you see how the Chinese market has quickly rebounded over the course of just 1 month, right? Chinese internet is up close to 50% just in the month of November. The broader MSCI China close to 32%. And that, if you compare to MSCI World and S&P 500, it's like staggering to see these kind of recoveries. Obviously, the recovery has been great, but it's still not completely given us back to the par levels that people would have entered into. So again, I think what will be more interesting for us to know is, what are the things that we can look forward as investors going into 2023? Is this like a short-term rally, coming off the bottoms of the market? What will make it more sustainable as we enter 2023 as well? So I'll hand it over to Brendan from this point onwards. Brendan, will love to hear your thoughts on China.
Yeah, thank you so much, both Melvin and Ritesh. And certainly, the poll is very, very, very interesting. And we'll touch base on a few of the concerns that were highlighted there. I think just Melvin, you just have to give me, you have to stop sharing your screen for 1 second, and then I can share mine. All right. So let's just dive right in. Just know it's getting late in Singapore as we start our day here in the United States. Just very briefly, Kraneshares is a China and emerging market focused provider of exchange traded funds. We also have a big focus on what we think is the, in addition to China, but also the next big investment opportunity in the decade and century to come, which is investing in climate change. That we are the provider of a suite of carbon credit allowance ETFs, but really the bread and butter, our main focus of the $10 billion we manage, the vast majority of that is in China investments. I write a daily research blog called ChinaLastNight.com, which is certainly free for anyone to sign up, just our take on what's happening in China's economy and capital markets. But I think, again, the most important thing we do is our research. We want to provide a balanced perspective on what's happening in China's economy and capital markets. So let's dive in. I think one thing when we step back and think about China, I think one of the things that we hear is that not just say China, but broader emerging markets, that they've underperformed US stocks over the last decade. And that's partially true, that if we look at the performance of the S&P 500 since the global financial crisis low, so that was back in March 9th of 2009, the S&P 500 is up 691% versus MSCI emerging markets is up 192, and MSCI China is up 145. So again, a lot of investors will say, compared to US stocks, emerging market stocks, China stocks have really dramatically underperformed. But the issue with that argument is that we've had in the last decade strong outperformance of growth stocks. Now, as Ritesh mentioned, my background has been in for 20 years now in passive investing. And so I would like to really look at how are these different indices comprised. And if we looked at MSCI emerging markets and MSCI China 10 years ago from a sector perspective, those indices were predominantly made up of financials, energy, and materials. Almost half of those two benchmarks were in those sectors, financials and energy stocks in particular, which are value sectors. So broad emerging markets, broad China were really value proxies. And the problem is we then went into a decade where growth stocks outperformed. And if we look at the performance of a growth sector in emerging markets and in China, how did they do? So remember, S&P 500 from March 9th, 2009 to yesterday was up 691%. MSCI emerging markets was up 192. MSCI China was up 145. But MSCI emerging markets technology was up 780%, actually beat the S&P 500. And MSCI China tech was up 1,844%. So you could have actually done really, really well in emerging markets and China. You just had to invest in the right place based on the current market conditions, which were favoring growth sectors like tech. But tech was only 11% and 2% of MSCI emerging markets and MSCI China a decade. So that's part of what we're trying to do at Kraneshares is give you more targeted exposures. So based on what's happening in the market, value versus growth, you can get those right exposures. Now, the other dynamic that's very important for investors in China is to recognize the disparity between onshore China. And what I mean by that is the Shanghai and Shenzhen stock exchanges. The Shanghai and Shenzhen stock exchanges are 95% owned by investors in China. So it's more reflective of what do the Chinese think about China. And we can contrast that onshore market with the offshore market. Now, the offshore market we define as Hong Kong stocks, as well as US listed China ADRs. because that's the historical definition of China. It's been Hong Kong and US China ADRs is the definition of China for foreign investors. So it's more reflective of what do foreign investors think of China. Now, just using 2021 as an example, you had the Shanghai and Shenzhen were up about 9 and 12%. Not an okay year, pretty good year. And we can contrast that with the offshore market. So the Hang Seng index in 2021 was down about 11%, but the Hang Seng Tech was down 31%. And China internet stocks were down almost 50%. So just imagine as an investor, you could meet an investor who said, I'm invested in China. I had a pretty decent year. And you could meet an investor who was invested in China, say in China internet stocks, and they'd say 2021 was a very difficult year. So this onshore versus offshore dynamic is very much something to be aware of. And to Ritesh, Ritesh pointed out that year to date, you've seen the China internet stocks are down, and we've certainly had a great month. So it begs the question, why are foreign investors so negative? Well, foreign investors have been very concerned about a whole host of issues, as the great poll from Syfe pointed out. Some of this is U.S.-China political relations, that people saw what happened to Russia as it was ostracized from financial markets. It was kicked out of the global banking system. Could that happen to China? And particularly if China were to invade Taiwan. You have U.S. regulatory risk, that there's currently a law in the United States that could see U.S. listed China ADRs delisted. You also have concerns about the zero COVID policy. In China, they call it the lives first policy. And some of this is really the economic consequence. We saw what happened to Shanghai and the effect that had. But we also had China's internet regulatory cycle back in 2021. And then we have China's economy. And I think the key on China's economy is there's a lot of concerns really about real estate. Not just, say, distressed real estate developers like an Evergrande, but also the fall in real estate prices, because Chinese households have a lot of their wealth in real estate. And as real estate prices have come down, that hurts consumer confidence. So we have all of these issues weighing on foreign sentiment. And I think one we'll talk about is this potential delisting risk, because for professional investors, it's difficult to hold a stock if you think it might get delisted. And so we could think about a stock like Alibaba, right? Great company, but can I, as an institutional investor, hold that stock if it potentially could be delisted? I can't. So what's interesting that's occurred is that because of the lack of institutional ownership of China, US listed China ADRs, due to the underweight to China in institutional portfolios, mutual funds, institutional separate accounts, this lack of institutional support has allowed short sellers to push these stocks down, knowing that there is no buyer. There's no buyer of last resort. And so from 2011 to 2021, short selling turnover on the main board of the Hong Kong Stock Exchange averaged 11% of turnover. So about 11% of turnover over 10 years was short turnover. That's increased 64% in 2022 to 18%. 18% of turnover in Hong Kong is short turnover. That's a very dramatic increase. Even more dramatic is over the 2011 to 2021 period, almost 3,000 trading days, you only had 2 days where short turnover was more than 20%. This year, we're at almost 50 days. So we went from 2 days over 10 years to almost 50 days year to date. So this shows that a part of what's happened, of why these stocks have underperformed, is because of this lack of institutional support. Now, I think what's another key point for all investors to recognize is the importance of the Party Congress that occurred at the end of October. The key to the Party Congress is that no policy changes have been done this year going into the Party Congress. That government officials in China have had to make sure that they have a job for the next 5-year political cycle. So there's been no policy changes. And what's very important for investors to recognize is now that the Party Congress is done, you're going to see a policy pivot, that there's 3 very significant issues that the Chinese government needs to address: the US-China relationship, zero COVID, and the real estate. And we're going to talk about how we've seen this policy pivot just over the last month. And that's part of why the market is reacting, is the stock market is forward looking. So it's saying we see what's going to be happen and it's reacting. Now the key is US-China relations to start with. China's economy is very geared to the West. It cannot afford to be ostracized, because it's simply too big. It's very dependent upon the United States, Europe, and Asia. So China can't afford to be ostracized. Now at the same time, the global economy can't afford to have China's economy ostracized. Many US companies have done great business in China. And so certainly the US government can't see these great US companies shut out of China's economy. They make up such a big percentage of their revenue. So the US and China need to figure out how to get along. And certainly we've seen this start at the G20 meeting. We had President Xi, President Biden meet. At the APEC meeting in Bangkok, you had further discussions between the US Trade Representative and the China Foreign Minister, and Secretary of State Blinken is expected to travel to, and just yesterday, US Commerce Secretary Gina Raimondo said that the US and China can't decouple. So we've seen the start of potentially better US-China dialogue. The delisting risk is a very significant one. This issue dates back, many there but basically, what this delisting risk is that there is a review of auditors done by the PCAOB, the Public Corporation Accounting Oversight Board. Public Company Accounting Oversight Board, the PCAOB, and China didn't allow those audit reviews. And so a law was passed to force China to do so. And just a few weeks ago, the PCAOB finished auditing Alibaba's auditor, which is PwC, Yum China's auditor, which is KPMG, and JD.com's auditor, which is Deloitte & Touche. This is a very solvable issue. Alibaba historically has said that they have no problem doing an audit review. So we're very confident. We believe that this should be resolved positively, and the PCAOB has said that decision will be made by the end of this year, just over the next few weeks. And again, that's a significant catalyst because it will allow institutional investors to come back into these stocks. These investors, institutional, are still sitting on the sidelines, even despite the great rally we've seen. Now, zero COVID is very, very important. In China, it's the lies first policy. It's really driven by the percentage of the population that is unvaccinated, particularly the elderly. And we've seen that evolve into dynamic zero COVID since the Party Congress. We've seen this really dramatic change. And dynamic zero COVID, we're going to see, we're already seeing significant changes where they've really dialed back. We've obviously had these protests just over the past weekend, and again, the market is anticipating. Just overnight, we saw more talk about relaxing potential quarantines. We're seeing a dial back, and again, the key is that these lockdowns and quarantines weigh on economic output. On a daily basis, within our China Last Night, ChinaLastNight.com research blog, we actually track the traffic as well as the number of people taking the subway in major Chinese cities as a way to understand, are they actually allowing more free movement within cities? And over the next week, it's going to be really interesting to see if we see a pickup in this activity. Real estate is another area that's very important. Again, it's really driven twofold. You have Chinese real estate developers like Evergrande and Country Garden and Sunac that took on a lot of leverage, a lot of debt to grow their business, and then they got into a lot of trouble. And then at the other hand is you have a significant amount of Chinese household wealth is in real estate. And so as real estate prices have come down, you've seen that it's weighed on consumer confidence. Since the Party Congress, what are we seeing? A big pivot. You're seeing a lot of measures to help make sure these distressed property developers can finish the projects they started, that they don't default on their debt. And we're seeing a backing off of really some of the language to try to disincentivize investment in real estate. So again, this is to try to prop up the real estate market to help consumer confidence. And certainly consumer confidence has been weighed by zero COVID. And again, these measures that we're seeing all happening since the Party Congress, that it's back to business in China. And we're seeing this on the three big issues that have weighed on foreign investment sentiment. Now we talked about this is what offshore investors have been focused on. Now, for onshore investors, 2021, I mentioned, was a good year. 2022 has been not a great year. It's not a disastrous year for this onshore market, the Shanghai and Shenzhen market, but it's not, but it has come down. And I think why it's come down is because of the effect of falling real estate prices, but also the effect of zero COVID on consumer confidence. That if I'm afraid I might go into lockdown or quarantine, I hoard cash. I don't spend it. So that hurts the domestic consumption story in China, which is why you're seeing this pivot, that China is going to try to raise domestic consumption. Now, part of why China needs to raise domestic consumption is as the global economy slows, manufacturing in China will slow, exports will slow. And we saw that just yesterday. Yesterday, the PMIs, export growth, new orders, very, very poor in November. That's driven by foreign demand. Foreign demand will fall as the global economy slows. Potentially the US enters a recession. Time will tell. To offset that weakness, they have to raise domestic consumption. Now China has been easing. They've been cutting interest rates. Arguably Japan and China are the only major economies that have actually been cutting interest rates to support. They've also done a lot of fiscal measures to support the economy. The key is they've kept a lot of their firepower, their proverbial their powder dry, that there's a lot more they can do to support the economy. And again, they've been easing while the rest of the world is tightening, which is part of why we think 2023 could be a really exciting year for Chinese stocks, particularly if these three big issues are addressed. Now, part of what's happened in the A-share market, in this onshore market, was you've seen a value growth rotation. And that's true for a lot of domestic as well as foreign investors. When they went into the onshore market, they were focused on growth stocks. And this year, in the S&P 500, the only sector positive year to date is the energy sector. So you've seen a bit of a value growth rotation happen globally. And that's true in the Chinese A-share market as well. So again, I think the key is it's back to business for the Chinese government, post-party Congress. 3 big issues need to be addressed. U.S.-China political, and we've seen the start of that. Certainly, the Republican Party took the House. They're probably going to do some anti-China legislation, but again, the U.S. and Chinese economies are highly intertwined. We've seen the zero COVID policy evolve into the dynamic zero COVID policy. The protests we've seen recently over this past weekend will only accelerate the movement away from zero COVID. Again, it's not going to happen overnight. It's going to be a slow dial back. And then on the real estate, we've seen significant measures post-party Congress to get real estate prices back up and to keep distressed property developers from defaulting on their debt. So the 3 key issues, and then I think the other one to point out would be by the end of this year, we're going to get a decision from the PCAOB on this delisting. And again, you've seen a lot of foreign investors stay out of these stocks. They're underweight China because of that risk, and they'll be able to come back in. So again, Kraneshares were very focused on trying to provide this balanced perspective on what's happening in China's economy and capital markets. We're always available, and certainly very appreciative of this opportunity to connect with Ritesh, Melvin, and the Syfe team, and certainly happy to entertain any questions in the remaining time.
Yes, absolutely. So thanks, Brendan. That was incredible. I think you summed it up really well in terms of the key things that kind of define the outlook for China as we move forward. Obviously, for us, what matters a lot is investors are invested, right? Like they have money that is gone into the market, as well as there are investors who have been skeptical and would like to see if there is finally headway, and is this an opportune time for them to start allocating some funds to China. Also, I think you saw as part of the poll that generally in this part of the world, people do have some allocation to China. I mean, it's obviously still 0 to 10% dominate the setup, but more than 50% were actually more than 10% allocation to China. So given that, I think it is pertinent for us to address how we think the market can evolve as we move forward. And to that extent, I think I just put together a few questions which I thought could be interesting as we look forward to 2023. We will also take some Q&A from people who have joined in together today. But let's start with this, right? Investor positioning on China obviously has turned a little bit more bullish recently on hopes of reopening. But the question really is what will it take for the markets to continue this rally into the new year? And what are some of the key risks to this continuation that you are seeing at this moment?
Yeah, I think the the things that can keep the rallying going or derail the rally will be these 3 big issues that certainly U.S.-China political relations is going to be key. We've made there's some communication and dialogue taking place, which is a good start. At the same time, I think that rhetoric isn't going to completely go away. That despite how intertwined the U.S. and China economies are, the U.S. government views China as a rival, as a competitor, and that's despite the great business people in the U.S. and China are getting along with one another just fine. I wish the diplomats could take a page from the business people. Certainly, on the real estate, if you had a lot of people have been concerned that a default from a distressed player could lead to some domino effect, create some financial crisis in China. Certainly, I don't think the Chinese government will just move dramatically away from dynamic zero COVID or zero COVID. It'll happen gradually. It'll happen incrementally. I think that pace will accelerate because the government's not tone deaf to the public sentiment on this issue. At the same time, there's estimates ranging 1.5 million Chinese could be killed by COVID if they just opened up. The estimates do vary. So really getting the elderly that are unvaccinated is going to be a key push, which we're seeing. So certainly the other risk would be this PCOB decision by the end of the year. That decision is politically motivated. So we could say rationally, these are US auditors. How could they not pass? But this was done for political purposes. So I think those are the risks. But I think the key is that, as we look forward to 2023, I think you'd have to say that as China reopens, its economy is going to be in an upswing. And I think as investors, we really want to focus on domestic consumption in China. Now that's self-serving because, we run KWeb. In KWeb, those internet stocks are domestic consumption plays. And so we're going to be, I hope, we're going to be big beneficiaries of the domestic consumption focus. And so I think there's a lot of investors all know about the risks in China, but there's very little examination of the rewards. And I think it's still very early days. There's going to be fits and starts. And I just want to say, I've been very heavily invested personally in KWeb. I'm down almost 40% in my position as of yesterday. But I'm still a big believer. I'm a believer that China's economy is not going away. And it's been a very difficult, really 2 years. Arguably, we could go back, to Trump and the trade war and the tech war. So I feel a lot of the pain of investors as well on a personal basis. At the same time, I am constructive. And it took me a while to understand, why are these stocks doing so badly? Like the companies aren't doing badly. Alibaba, I think in terms of current assets, it's almost 40% of the market cap is in cash. These companies are buying back stock, but it took me a while to understand that what's happened is this underweight to the stocks because of this delisting risk, has allowed short sellers to drive these stocks down. And that's part of why we're getting this dramatic rally is short sellers are getting run over. Short sellers are forced to cover those positions.
Absolutely. No, I think some of these are very important points for everyone to note as well. Same as you, Brendan, I'm highly invested into China as well. Got like potentially more than 15-20% of my money put in there. And obviously, it's not been an easy ride, right? And, while for someone like us who, supposed to be more professional, we can see the bigger picture and we have potentially a much longer holding power. For the average retail investor, sometimes these are hard, pills to swallow, and they tend to give up, right? Like, especially I think if you look at last 2 years, it's 70% drawdowns into the Chinese, tech sector. So that obviously impacts quite heavily. We've seen investors once they, start losing money and, they have their beliefs kind of, eradicated to a certain extent and they don't want to look at it anymore. But having said that, I guess let's continue on our discussion. I think one of the other aspects that I was looking at is, the pivot that China has had in terms of the new economic development model, where, things like common prosperity, environmental protection, and enhancing security, these have kind of taken shape where what I believe, is happening is they are ready to give up a little bit of the short-term growth with a, hope of being long-term greedy and being able to do a more sustainable aspect to that growth going forward as well. So I think the important question is like, will China be able to sustain the kind of growth that they had seen in the past few decades? If not, like, is that an area of concern? Or, do you think, even with the current, new policy developments, it is actually, a much more sustainable form for them to, move forward as well?
Mm-hmm. Yeah, I think it's, globally social and wealth inequality is it's a big issue, and it's something that you see the governments react or do things in very just different ways. And I just think about being in Hong Kong at the end of 2019 when there were a lot of protests, and particularly by young people who are worried about their future. And Hong Kong can be a great place to live, but it can also be a very difficult place to live. I don't, having been to Singapore, only once, I can't really speak to, how Singapore's dealt with it. But, I certainly think about, when I take the train into New York City, my entire life, I've take the train past these housing developments, public housing, and nothing's changed, in decades to deal with that. So, China in, many of us, when we travel to China, we go to, the big cities, Shanghai, Beijing, Shenzhen, and that part of, there's elements of China that are very wealthy, that are to developed market standards. I've been to like a Lamborghini dealer and a Rolls Royce dealer in Beijing, but if you travel outside of those big cities, if you go out into the countryside, China becomes a developing country very quickly. And I think the government is trying to make an effort to balance out some of the great wealth and prosperity that the cities have enjoyed. The East Coast of China, how do they bring that to the rural areas? And time will tell, the success, and certainly it's an issue that countries will deal with very differently. Here in the United States, we have a progressive income tax, right? The more money you make, the more tax you pay. I would argue that's that's trying to provide common prosperity. So time will tell. But I don't think some of the media headlines are, they don't really talk about the poor part of China and the efforts to raise it up. That to me seems laudable. On environmental protection, it's an area that we do believe investors should be focused on. Within the Kraneshares suite of exchange traded funds, we do have a China clean technology ETF. We also have a global electric vehicle ETF, and we do think that it's a key area to focus on. And then on security, the way we think about security for China is that China really, part of why the government tried to disincentivize investment in real estate is that, does China need more apartment complexes, or does it need more semiconductor chips, or biotech, or high-end manufacturing, or the technologies that the economy will require? And so I think some element of reaction to some of the saber rattling from the U.S. government will be a push to develop internal technologies, as opposed to relying on foreign companies. And that, to me, again, we provide a starboard ETF. So the starboard is like China's NASDAQ. It's really a stock market within the onshore market focused on these growth technology plays. And so I think when we think about a China allocation, and we think these are important areas investors should be focused on. KWEB gets a lot of attention, probably particularly going into next year where domestic consumption is going to be such a focus. At the same time, I think these other areas are of interest and worth an investor taking a look at.
Awesome. We are getting actually a huge number of questions. So maybe I'll take a pause on my questions first. Melvin, do you want to start covering a few of them? I think some really, really interesting questions coming in.
Yep. So I have a particular one that I really like. So Mark was asking what are the next dates and points to watch for the potential delisting risks of US ADRs from PCOAB?
Yeah. So the PCOB chairwoman, Williams, spoke at a conference about 2-3 weeks ago where she mentioned that there would be a decision made by the end of this year. They had previously, the PCOB had previously stated that, yes, the auditors left, but I always felt they would leave. They got to Hong Kong in mid-September. Thanksgiving is a big holiday here in the United States. Those auditors want to go back and see their family. So, they mentioned that, we shouldn't take their leaving as, we shouldn't infer anything from it. I think what's key is that this was a political decision, and we've had a big political event here in the United States, which is we had our midterm election, and so an argument can be made that with the midterm election behind, could you have some good China news, which would be allowing these companies to remain listed? Again, I don't think the three auditors, so they're not auditing the companies, they're auditing the auditors. Yeah. Those are US auditors. You can't, but the key is that this was done politically, and politicians, they don't read annual reports or balance sheets or net income statements. You can't apply a rational, politicians don't act in an economically rational way always. And so I believe this does get resolved positively. However, there's still a lingering concern that for political reasons, there could be a negative judgment. The key is that these stocks, they basically trade at delisting valuations. And so, within Kraneshares, within KWEB, we've moved a lot of our exposure to the Hong Kong shares on the ADRs. We're prepared to move all of KWEB to Hong Kong. So we're trying to act on behalf of our shareholders to protect them. And we take that responsibility, very seriously. I don't think anyone knows more about the PCOB and holding foreign companies accountable act than Kraneshares of any asset manager globally.
Great. So maybe one more. Actually, just now you addressed another question from Mark. Will a delisting actually impact KWEB? Because back then, I think you guys have already started shifting over to the Hong Kong variants.
Yeah, we've moved, and right on Kraneshares.com/KWEB. If you scroll to the bottom, you can see, we've moved Alibaba and Baidu and JD and NetEase, and and then we're prepared. We're able to move more names. We've not moved some names just because we don't see that the Hong Kong trading in some of the dual listed stocks isn't that high yet. So we're prepared to move more. I just think it's critical for investors to recognize that we've done more on this issue than most, virtually any asset manager I'm aware of, and we take we take that responsibility. I mentioned I'm very heavily invested in KWeb personally, and that's I'm not doing this to protect my money. I'm doing it to protect your money. But we take that, again, we're all over this. We're gonna do everything to protect investors.
Brendan, in terms of percentage, it's close to 70%, right? That has moved to Hong Kong already.
Yeah. And a year ago, it was the other way around.
Yeah.
It was virtually all US ADRs. Obviously Tencent and Meituan are primarily listed in, but we moved a lot.
So I think one from Dave. So he's asking, we talk about the importance of resolving the three issues, but the uncertainty forward is just too great. So how do we have the confidence to put more money to work there? Maybe in the long term, but definitely not over the next year or two. Do you think he's right? Do you think he should hang on to his cash, stay away from China for the next year or the 2 years actually?
Well, I think why I'm very positive for next year if we see this reopening in particular, if we see some improvement in US China, if we see continued movement to dynamic zero COVID, this reopening, if we see further measures to support the real estate sector, and the market over the last month reflects just how the market is forward looking. So I think what's very interesting is that when you look at China relative to other countries globally, you have this easing cycle, you have policy support, but you also have, for 2023, you're going to see China's economy grow 5%, if not more, and that's going to be one of the top performers globally. The rest of the world is slowing down. China is coming out of this trough, and yes, there's things that could derail that. I would just argue all of that negativity is built into stock prices today, and I think this good news can allow for a significant pivot. And again, I think there's a lot of pessimism around China, and every day you look at the media, in the US media in particular, maybe Japanese media, it's always negative, and it just doesn't matter. It doesn't matter. Wall Street Journal, always negative. Doesn't matter. So Financial Times, which is owned by a Japanese company, always negative. So I think one of our early investors always said, why he was always interested in us is he's like, his saying was, I love markets that are underowned, unloved, and in an uptrend. Because in his opinion, that's where bull markets come from. That people are under allocated, that they're skeptical, that you can't give the shares away. And I think there's a huge overweight to US equities at a time when US equity valuations are quite high. You've got a bit of a Fed tightening cycle, and the US economy is slowing. I think that's what people are going to be surprised by, even once the Fed is done tightening, the possibility for a US recession at the end of next year. Time will tell. I don't pretend to know. I can't predict the future, but I look at probabilities, and I would say the probability of China outperforming is high. The one thing I would point out is like, what part of what Syfe does, and is provide broad asset allocation, right? And I think one important thing I would point out is that the Chinese market is volatile. Emerging market stocks tend to be very volatile. So if you look at a measure of volatility like standard deviation, you'd see Chinese stocks are much more volatile. than developed markets like the United States or Europe. So as an investor, we have to almost volatility manage that position. And I think investors like Kraneshares, like, being in Singapore or in Asia, the importance of China, it's not going away. But those of us that have been closest to China, we had the biggest allocations to China. And so we actually got hurt by this the most. So I think the key for me is that my takeaway over the last 2 years is that I want to own this onshore and offshore dynamic, because these two markets are going to move differently. And then I have to be aware of the volatility and that I'm comfortable with it, because I have to be able to, if my position to China is so big that if it goes down, I can't add to it, that's a problem.
Yeah.
The problem is not that it goes down. It's that if I don't have enough to kind of come back in, then I can't rebalance. So I think that's, this onshore offshore dynamic is a real thing, but then also, do I have a position size that is based on the volatility? If I need to rebalance, if I need to add because something is down, I can, right? So that's a key lesson that I've learned over the last 2 years.
Awesome, Brendan. I think let's quickly, on that note, cover a little bit about Syfe's platform, because I think you talked about allocation to China in a global portfolio. Just to kind of review our suite of portfolios. So Syfe, we have two parts to it, right? So on the wealth side, we have our core range of portfolio that are supposed to be globally diversified across asset classes and cater to different sort of investment time horizons as well as risk appetites. We have some satellite portfolio investments. So you have our REIT portfolio. As I shared earlier, one of the most popular, products on our platform. We also have, thematic portfolios where you can, take part in mega trends or get specific exposures to countries such as China. We also have, a way to custom build your portfolio. So these are core and REITs and themes are discretionary, but if you want to custom build your own portfolio, selecting your own ETFs and underliers, you can do so using our platform too. We have a cash management solution, which again is an alternative to putting money in the bank, very liquid, no gimmicks, no lockups, no limits. And then we have the Syfe Trade platform through which you can invest in the US market and the Singapore stock market. Now, coming to China and the case for China in a globally diversified portfolio, I think this was one of the parts that was covered already in Brendan's slide as well. China forms more than 18% or contributes more than 18% to the global GDP. So if you were to do a market cap weighted allocation to China, it won't be the 4-5% of what you see as part of the global indices. Like when you look at MSCI World, typically the China allocation is low single digits, versus like if you look at its economic contribution, it is much, much larger. So my argument is it does warrant a greater allocation to China. We cannot ignore, its contribution to the global economy. The other part, I think, which was again very interesting that Brendan brought into, notice as well, was, more specifically, the A-share market is very, very lowly correlated to the global market. So when you put together China as an allocation in a globally diversified portfolio, it helps with diversification benefits. So if you look at the chart on the right, and you look at the row of China, the numbers there, 0.5% approximately, is the average correlation to, say US market, Europe, and the other developed markets. Versus when you look at the correlation between, the developed markets as well, you will see that correlations are much, much higher. So when you put China in a global portfolio, it acts as a portfolio diversifier. Now, that brings us to the question of, how we allocate to China. We think China is an important factor that needs to be considered. We believe we are, doing it preemptively. Eventually, the global indices will adjust and will have their rightful allocation to China. And if you look at our portfolio, we have just made it kind of representative, right? So that's why if you look at our 100% equity portfolio, where the benchmark is, say, an MSCI World, we have close to 15% allocation to China. Now, obviously, that has had some impact in terms of performance of our portfolio over the last 1.5 years. But we still did pretty well because again, as part of the diversification, it contributed. And if you just look at the last 1 month and year-to-date performance of these portfolios, they have done much better compared to benchmarks, right? As China is coming back, that has that positive impact on the overall portfolio. And as we head into 2023, this, if there is this continuation, you will, continue to see that factor play out. And I think, Brendan, you mentioned it as well, right? Like, investing in China comes with its risk, right? You need to manage that volatility. You need to understand that, it is going to be a bumpy ride of sorts when you invest into China. But investing in China also brings its rewards, right? So that's where, if you remain invested, if you can commit yourself, then that's where you can also reap the benefits of the rebounds. That quickly brings me to the other point. I talked about Syfe thematic portfolios. We have different sort of ways for you to, kind of get exposure to different mega trends, but we also have a pure China exposure, right? So there is this case, that is developing where, should you have an all China equity portfolio? And if that is one of the things that you're looking for, rather than doing your own research, you can take a look at our China growth portfolio, where the focus is a little bit more towards, the more dominant kind of Chinese stocks, towards, companies which are politically, potentially less influenced by government decisions. It does have a higher allocation to technology sectors, but more, so to sort of cater to the consumer side of things, right? As China is moving from an export-oriented economy to a consumption-driven economy. And if that kind of continues to happen over the next few years, some of these sectors will dominate how, the Chinese economy evolves. Obviously, we do have Kraneshares as part of our allocation, both in our core portfolios, as well as, part of our composition into the China growth theme. Also, people are able to change themes, right? As part of our custom portfolio, if you don't like this allocation, you want to add, more, say, Kraneshares ETFs or other ETFs, you're able to do so by saying that, okay, I'll take this template, but I want to change this aspect of it, right? So you can do that, going into the custom flow. And then we also have the trading platform, right? So, there is obviously this thing about the delisting risk when you're investing into the US listed Chinese stocks, the ADRs in US. But obviously, some of these individual names are much more liquid when you're trading in the US market. So some people still prefer to trade them in the New York, exchanges and all. If you are, pretty skeptical about the delisting risks, you can take those exposures via, ETFs, which are also available through our platform, right? Again, all the Kraneshare ETFs are available for you to trade through our trading platform. And through that, when you take that exposure, a manager like Kraneshares will manage the underliers and make sure that, if there are delisting risks, those are kind of inhibited because, they will shift allocations to the Hong Kong listed ones for you. And just a quick plug. So if you are a new investor, there is a free, some, promo for you to join in, get some fee waivers, as well as people who are already invested with our platform. You can also get some fee waiver if you start to top up. All right, so that's mostly what I wanted to cover. I think in the interest of time, maybe, Brendan, I don't know if you have a few more minutes, we can just quickly wrap it up if there are some questions that we missed out on.
No, I think we covered a lot of ground, Ritesh. Certainly very appreciative of the opportunity. I think, we've mentioned a few times, China's not going away. And I think nor is Kraneshares, nor is Syfe, and, very much always available, and, looking forward to coming back in the future. And, let's see how things play out over the next year. I'm constructive, but time will tell, and, I think there's some real opportunities.
Absolutely. Thanks so much, Brendan, again, for your time today. There are, again, a few people had asked us that, could we share more, sort of information in terms of articles and, write-ups and things like that. So obviously, as we were talking earlier, will be great for us to collaborate and see how we can bring more, kind of information to our investor community as we move forward and collaborate together on that.
100% looking forward to it.
All right. Thanks, Brendan. You have a good, restful day, and we will continue our discussion as we move forward.